Can we please have the videos? Thank you. Ladies and gentlemen, moving on to our next session right here. A session that is Institutional Investors' Journey from Entry to Exit. More often than not, the voting behavior of institutional investors tends to impact on the decisions being taken in the corporate universe. How do institutional investors choose the companies that they invest in, and what decides their behavior pattern while they are invested until they exit the company? So, ladies and gentlemen, inviting our panelists to join us on stage for this panel discussion, Institutional Investors' Journey from Entry to Exit. Our first panelist to join us is Mr. Balasubramanian. A loud round of applause, please. The Managing Director and CEO of Aditya Birla Sun Life AMC. He is the stalwart of the mutual fund industry with over 3 decades of rich experience. Prior to assuming the role of CEO in 2009, he served as the Chief Investment Officer for 3 years. Earlier, he worked with a General Insurance Mutual Fund and Can Bank Financial Services. He has been on the board of AMFI since 2009 and was its chairman from 2016 to 2018, being reappointed to the same position in 2021. He was till recently chairman of AMFI. He's a member of the Board of Governors of the National Institute of Securities Markets, NISM, and a member of the Advisory Committee of SEBI, Investor Protection and Education Fund. He's right here with us on stage. Ladies and gentlemen, Mr. Balasubramanian. Joining him on stage, our next panelist, Mr. Rajeev Gupta. Good afternoon, sir. Welcome. He is the founding member of Arpwood Financial Group, a merger and amalgamation investment bank, Arpwood Capital, and a mid-market private equity buyouts firm, Arpwood Partners. Prior to setting up of Arpwood in 2012, he was a global partner at the Carlyle Group and earlier the joint managing director of DSP Merrill Lynch. Ladies and gentlemen, please welcome on the stage with a loud round of applause, Mr. Rajeev Gupta. Good afternoon, sir.
Very well.
And joining us and completing our panelists on stage, ladies and gentlemen, please welcome with a loud round of applause, Ms. Renuka Ramnath. Welcome, ma'am. Good afternoon. She is the founder and managing director and CEO of Multiples Asset Management, which she set up in 2009. Prior thereto, she was the managing director and CEO of ICICI Ventures, the venture capital arm of the ICICI Group. She has also served within the ICICI Group across investment banking, e-commerce, and private equity. She is the chairperson of the Indian Private Equity and Venture Capital Association. As an independent director, she is the first woman professional to be a chairperson in the Tata Group of companies. Ladies and gentlemen, with a loud round of applause, Ms. Renuka Ramnath. Moderating this session, I'm going to hand over to Mr. Balasubramanian. Sir, all yours.
Good afternoon, everyone. Of course, it's tough to have sessions, one in the afternoon, and second, after multiple round of speakers who are experts in their respective field and talking about institutional investors' behavior in the capital market. Of course, I have been part of the mutual fund industry for the last 32 years and seen the industry is evolving. We've also seen governance evolving each passing year for a variety of reasons. One, of course, the fiduciary responsibility that mutual fund industries have got on them, given the fact that large pool of retail investors have been coming into the mutual fund industry. And each passing year, the regulatory tightening also have been ensuring that all of us and institutional investors are able to deliver the fiduciary responsibility that we have and invest in the best interest of investors. At the same time, we avoid any accident. At the same time, create value for the investors. So that's, I think we have dual job. One, we have to generate return. At the same time, we have to pay attention to how the companies are run. And we also cannot play the role of an activist, unlike Renuka and Rajeev, who can play an activist role, but mutual fund cannot play an activist role. And ensure we ask the right questions to the management on capital allocation and so on and so forth. These are a few things that we can do. I think as post 2009 crisis, of course, it was a Satyam period where all of us, industry players, I still remember that we got together. That's the first time the mutual fund industry, all money managers came together and drive one single agenda of changing the behavior of corporates. That's something we started doing, and since then, there is a lot of changes that have come in the Indian mutual fund industries, whether it is investing in fixed income, give money to the investors on the fixed income space, or in the equity capital space. The other thing which of course has come is the stewardship code was introduced. Of course, the last few years, there has been a huge amount of discussions about stewardship code which has to be followed, especially the voting has been made mandatory. I think when we started voting, we always, as institutional investors, mutual fund players, we take the middle path in the sense that if it becomes assumed as a neutral, you take a call of abstaining. And invariably, till about 2014 to 2019, all of us would have only abstained from voting. The best way actually to be neutral, given the fact that we have a public image, and second is whatever we do, it comes in the public platform. If it is good, of course, we will appreciate it. If it is bad, it also get equally negative publicity. Therefore, so I always used to maintain either for or abstains or against. Then as the time progressed, industry players started realizing the importance of even saying against. In fact, sometimes it goes to an extent that against you do for such things as increase in salary of a managing director or any professionals you recruited on the company's board at outside the market comparable salary. And sometimes as a money manager, we vote against that. I still remember a case where Tata Motors, when they were trying to revive the whole business from where they were, there was a resolution was being passed for appointing a gentleman from overseas, and all of us as a money managers felt, why should somebody be recruited, that to outside the country when you cannot get a talent within the country, and get a person from outside the country, and that too at $1 million of salary. In fact, the first round of voting, all the entire mutual industries voted against. Then as a CEO of the company and came to know from the management, then I had a second round of discussion that understood the importance of getting a talent from outside the country and get that person for reviving the company's prospects to create the shareholders' value. That's the way then the company went for a second round of voting. Then after having a deep understanding, all of us voted for. So that's the kind of I've seen in the past. And since then, the money managers have been exercising the full right to vote for and vote against. In fact, voting against also have gone up. Just to give you some statistics number, till 2014, 2019, 88% of the votes were in favor of for, and 3% of the votings were against, and 9% were abstained. And the same number in the year 2020 to 23 is actually doubled. Against the voting has gone up from 3% to 6%. So that again is the progress that is being made by institutional investors, especially in the mutual fund space, as the size becoming bigger, as the number of companies in which make investments is becoming larger and larger, and more companies coming to the capital market in general, and regulatory stewardship responsibility is also quite a lot in ensuring that whether the board is constructed properly, whether they have the right set of talent, skill set in being part of the board, and assess them very clearly, and basis which you assess. That's something I've seen, an improvement that I have seen. From 3%, the vote against has gone up from 3% to 6%, and the people who are abstaining, it used to be about 9%, significantly got dropped to about 2%, which essentially means the institutional investors like mutual funds have been exercising the right to ensure that managements are asked the right questions and so on and so forth. Also, we have gone through the dilemma. I think there used to be, when I was a CIO till about 2009, most of the public sector companies, the independent directors used to get appointed, and even myself used to get a call from a variety of people that so-and-so person is being appointed as independent director, and Bala, just please ensure that your team discuss this and ensure you vote in favor. If it is 1% coming as a recommendation, of course you can vote in favor. If 3% being recommended for 3 different set of people with the high quality of high credentials who are actually recommending, at the same time 3 people are being recommended, then what call you take? That's the way we all used to abstain. They were moved away from abstaining to actually voting for and voting against. That's the trend that you have seen. So therefore, the industry, of course, is evolved. The earlier discussion, there was a discussion about, of course, I'm going to ask this question to both of you also. There was a discussion about ESG, and we also, there was a disconnect, right? I think in the sense, the companies which are doing extremely well on ESG norms till about 2019, pre-COVID, companies who used to follow the ESG norms were trading at an extreme amount of premium to the normal market. I think as the COVID broke out, and then as time progressed, as the energy shortage started coming in the global market, ESG was completely forgotten. The market started rewarding ESG companies, non-ESG companies, as a value companies, and they started also rewarding. So this is something, as a money manager, we go through the dilemma. The question is, if you just stick to only one theme and one practices, if it creates the value, it's fine. If it doesn't create a value, then how do you actually change the course in terms of ensuring that you also participate, at the same time ensure the companies are also run properly. So with this, my opening remark, of course, we have 2 of the stalwarts, one of the old industry players, both Mr. Rajeev Gupta, who runs the influencing role by of running the large PE firms, as well as the investment banking company has run. The same thing goes with Renuka, whom of course I've been knowing for the last 30 years. Again, I have played a very influential role in every respect in the capital market. So I would like to hear from both of you your opening remark. In general, we have seen cycles, we have seen how institutional investing pattern is evolving, and companies also, of course, are growing, new managements are coming. How important in terms of ensuring that governance, practices, policies, while of course building the initial stage of the companies, while evaluating companies as a private equity investors. Raj, you want to go first?
Yeah. Okay. Yeah. See, first of all, since we're talking of governance, I think it's important to give small and clear definition to what governance really means. And the way I see it, and I have seen it, is governance is nothing but board oversight that makes sure that companies will create value to their full potential. So really, create value to full potential is governance in a manner that the risk is at an acceptable level and in a manner which is fair to everybody. So really, there are 3 parts to governance definition in my mind. Companies should create value to full potential through board oversight. Risk should be within acceptable limits. And thirdly, the way the manner of achieving the objective should be fair to everybody, majority, minority, all shareholders. This is governance. Now, the end result of governance is what? The end result of governance is fair treatment to everybody and value creation with acceptable risk. if you look at the Indian environment, and I worked many years in a foreign private equity company, not as good as Renuka's, of course. But one thing we saw in that heady environment of the first decade of this millennium, going into the second decade, is this massive growth of China. And it was consistent, touching double figures many times. And one used to keep wondering where the capital is coming from, and how that capital is taking that risk. But the growth was very real. Every indicator of that growth, and we all started with doubting that growth. Growth was undoubtedly, real and in place. Every indicator of that, whether it's consumption of steel, cars, electricity, railway wagon loading, port statistics, what have you, was showing that China is growing. So as China grew, and they grew to the second largest economy in the world, one thing they did not do, Bala, and you'll appreciate this, so will my friend Renuka, China did not create value. So that means there was a massive failure, and I'm being very, say in all humility, that there was a massive failure of governance somewhere in China, or that capital that China got did not care for governance. So it was a different type of maybe state sponsorship or what have you. And Indian capital, on the other hand, we grew at a smaller pace. Capital was circumspect, it was private capital, but we created enormous value. I remember 2005, 6, I think index, I'm talking Bombay Stock Exchange index, was about 5,000-6,000 Bala, if I'm not wrong, maybe 6,000.
Yeah.
Today it's 65,000, whatever, 66,000. So 11 times in about approximately 16 years. This is the extent of value creation. The same story, of course, we took 10 years, 12 years to readjust to the new environment that, economic environment that was created. So clearly, I think we are beneficiaries of governance. We have run the companies competently. We have generally been fair to, minorities, etc. And of course, institutions have helped. So I think we have a good track record in governance. Second point I want to make, and before I hand over to Madam here, is that during this period, from 2007, Mr. Damodaran, sir, you were chairman of SEBI also. I think one thing is maybe partly some 5% role played by Bombay also. We've had excellent and very capable leadership of SEBI. In this period, what has happened is tremendous power has been given to minority investors and to the independent directors. To the extent that if you look at the composition of nomination, remuneration committees, audit committees, the powers vested in them, they have to make a recommendation to the board, only the board can then decide. In some respects, board has been placed in the position of a shareholder. You can say yes or no to the recommendation of a norm committee. You can't originate yourself. That's the law as it stands. There's tremendous change that we have in India. And a lot of people come and tell us, obviously we also bankers and we work with, apart from being private equity investors, we work with management. And a lot of time people come and tell us that, listen, this is really going overboard and India has anti-promoter and capital has no respect. And we tell them that our perspective, while, you're our clients, we love you and all that. Our perspective is different. Every regulator is looking at China. Every regulator is looking at what capital flows can do to an economy. And while, yes, we have the best ratio in the world, return on capital, price to earning ratio, price to book, Bala, all that. Fact of the matter is that on an absolute scale, China has done so much better because they attracted so much capital. So the question for the regulator, sir, you'll agree, Mr. Damodaran, question for the regulator was, what should India do to attract that capital? And therefore, a whole series of things that have been done by Indian regulators, particularly on the security side, is designed to attract capital, and I think we have succeeded. So this is the picture that I carry. Nobody is anti-promoter. The regulatory changes have brought in capital. They have helped us, and while we do all this, I think growth has kept up. Investments continue to happen. Companies are very well traded, very well managed. I think we are in a position today where, not to say that institutional investors have not contributed, they certainly have contributed, but the overall picture, to my mind, is very, very positive. And let me pause here. We play in this arena in private equity. and how we do things is that we, I would say, take guidance from the fact what has worked in India and do more of that. And we have seen 80s and 90s and all that. We know what doesn't work and we stay away. I think in summary, that's what we've done.
Yeah.
Thank you.
Yeah, thanks, Rajeev. Renuka?
Yeah, so good afternoon. Happy to be here. First, I would like to talk about what governance has meant to me practically. Given that much of corporate India was set up by so-called promoters, who pretty much held large majority stake in the company, if not all of it, there was no difference between the person and the company. The promoters thought that I and the company are the same, and since the company is mine or the majority of it is mine, I am in the best position to decide what is right from wrong. I alone will decide that. I think demystifying that company is different from you irrespective of your stake in the company was the starting point of talking about governance. That company is an independent entity. Shareholder is but one stakeholder in the company and not all the stakeholders in the company. And the company has an obligation towards all the stakeholders in the company. And therefore, what should be the governance which will satisfy the needs of all the stakeholders in the company was, I think, the first step in the ladder of governance. The second important point why governance is important is the sustainability. Even in the previous panel, they spoke about interlinkages. If we look at any company today, right? I mean, whether you're in manufacturing or you're in services or you're in deep tech or you're financial services, the interlinkages are so high that if you have to build a long-term sustainable company, someone who is looking at it in an impartial way, who has no direct interest in the company certifying that your practices, the numbers that you report, the way you conduct the affairs of the company are trustable, you are not assured of longevity of the company. If you are not assured of that sustainable longevity of the company, how can another party engage with you in any meaningful way? If you are not part of a powerful ecosystem, how can you anyway create long-term value? So this whole understanding that I am but one element in a chain of ecosystem players, and I need a third-party verification that I am a bankable company, I am a trustable company, whether as a supplier or as an employer or as a potential, a company which is seeking capital or a company that is seeking debt. Your limit for growth and your limit for sustainability is going to be really very, very short kind of runway. I think these are the two key reasons why governance becomes very, very important. It's not about, for me again, the third thing is, it's not about what SEBI is saying. It's not about what listing guidelines are saying. It's not about what company law expects you to do. It is about yourself. If you are a principal stakeholder in the company, you want to build the company for long-term sustainable value creation, what are the value system you stand up for? Do you think not reporting numbers transparently is a good way to grow the company? Do you think not having an independent oversight in your company through good board governance will help you really scale and be around 10 years down the line? Do you think not having good risk management within the company is going to be really useful for you? Right? So it's, for me, it has never been about what the regulator said or which box I need to check to tell my investors that I am compliant. Call it ESG, call it by any other name. It is about your own values, which is why in multiples, even in companies where we began with 90% or 100% shareholding, we had independent directors who will bring that fresh, unbiased pair of eyes into the affairs of the company and make sure that every action in the company is done keeping in mind the best interest of the company and not any one stakeholder. And as again speaking for just 10 seconds about multiples, I have my CFO here. I have a simple mandate to him, which is in none of our portfolio companies we will have a blowout. Do what it takes. So if you set that as your bar, then the way you go about carrying out your activity, right from the company you choose to invest, I think the first filtration has to be, who do you choose to give this precious capital? Whether it comes from domestic resources, international resources, institutional investors, individual investors, it really doesn't matter. Capital is very scarce. Capital is very, very scarce for Indian entrepreneurs, so it has to be channelized only to the deserving ones. So the first filter is, who do you admit? Then the next is, how do you navigate the journey? And the last is, how do you hand it over in a platform which assures you long-term sustainability and long-term good governance? So I think a lot is about what principles we take and less about who is regulating and what they really want.
Yeah, I think interesting, Renuka and Rajeev, I think you took the example of China. Definitely, I think their governance standards does reflect both in the economy as well as in the market. We are able to see that quite visibly. I think from India point of view, of course, we all as a money manager, I think you mentioned about ROE, price to book. I think as a listed, we only trade in listed companies. Of course, you derive value, both of you derive value in companies, bring it to a certain level, and then bring it to the listed space. That's where our entry comes in, which essentially means when we as institutional investors look at companies, when established, balance sheets are disclosed, know the processes, practices, the product sustainability, all this comes in the form of a disclosure. Therefore, we are able to assess it. Of course, we do pay attention to the financial ratios, which helps us take a broad or informed decisions. Therefore, to a large extent, our role comes in the form of just using some external agencies, just do some kind of checks, audit checks and channel checks and so on and so forth, and basis which you of course assess it. And management, the 70% ownership versus 20% ownership has got its own way of looking at both on the governance side as well as on the liquidity that is available in the market, basis which again one always applies a premium or discount in the valuations. See, for us relatively a little more easier, I would probably say. But when it comes to the question of your investing, the question of one, all the companies in which you make investment are either completely in the nascent stage, startup companies, going to become a leader in the futures for which you'll have many unknowns, good profit versus bad profit. And there again, it many times it comes as whether it comes from a good profit or bad profit. Again, ESG is something, somebody is non-ESG compliance, maybe we can call it a good profit is very good, but not a good profit. And many such dilemmas will come. And when you see at various stages, because you're all entry level players and you bring in huge amount of capital, you bring in there. And a huge amount of capital you are putting and taking a bet on management. I think Renuka mentioned about the larger ownership. And when you start up company 100% owned by them and you become one of the shareholders, any key insight that you can provide in terms of how these investments when you make, what are the factors influence your decision making, and yet ensuring that governance, other standards are being met?
We actually only do buyouts. So we take majority to start with, the mid-market buyouts. So I would say that we basically look at, in an engineering sense, we basically look at the incremental returns on our capital and on our presence. And I say that with all humility, because we operate in mid-market, we believe that our access to talent goes up with our presence. And so we try to assess that also, that okay, some capital will go in some better management will go in, what can that company achieve? The fact of the matter is that generally the platform that you buy into is a proven business model, a proven ability to expand, but the quality of people is not the best. Risk-taking appetite is low. Typically, the promoter is in late 60s, so they want to, look for someone more energetic, some better capital, some better management. This is what we do. The fundamental analysis does not change, which is basically that is it a good industry? Does this company comparatively disadvantaged or not? And therefore, what can this company aspire to do? Our experience has been as follows. First of all, extent of financial fraud is low, it's not high. It does exist, undoubtedly. And if you want it, you will come across it without too much effort also. But it's not that everywhere you are up against financial fraud. Salesmanship, yes. Financial fraud, no. Secondly, our experience has been talking to promoters who build businesses. Typically, they have come from, many of them started early 90s when India liberalized and all that. They've now been 25, 30 years here. They came at like mid-30s, they are now late 60s and all trying to exit. Many of them came from US or wherever. So I think what they have built is reasonable businesses, did not have access to talent, limited capital, limited risk appetite, ran into some challenges, but built something that has proven itself in the market, many times regional, and they can be built. You superimpose on that talent and superimpose on that management. I think Renuka referred to independent directors and all that. They certainly help. Renuka, I'll just add one more point onto that. Our experience has been, with all due respect, that first of all, don't fill up the board with private equity nominees. It doesn't help. Yes, you want to have say in critical matters. So our typical structure is 2 nominees from Arpwood, 1 CEO who's hired, and 3 independents. So it's always even number of directors we always aim for. So nobody has superiority. Second thing is, as I said earlier, governance is all about making sure a company operates value to full potential. If you don't keep briefing the independent directors and tell them about technological changes, regulatory changes, what the competition is doing, how competition is achieving what's happening in the rest of the world, what should we be thinking about. If you don't brief the independent directors, it is a very suboptimal way of working. You cannot, there's a lot of wisdom, and in this whole room I can see several people from whom I have learnt, and if I start naming them, 10 minutes will be gone, I assure you. But you have to keep them briefed because we are bringing them into an industry that they may not know. You bring them for their wisdom and experience, not for industry knowledge, is what we have seen. This latest issue of Fortune, I'm sure many of you would have read that. The company which has grown the fastest last 4 years, 19, 20, 21, 22, so pre-COVID into I'm talking calendar 22, is a company called Builders First Source. 55% CAGR, they are retailing construction materials, $20 billion revenue. Now this is America, mature economy, and 22 interest rates were going up, building construction trade. So if this company can grow 55%, it just tells you enough niches exist in this world. Look for a niche, get the right management in place, get the right governance in place, and give space to management. Learn how to respect talent, learn how to be out of the way. Their management, you're the board, there's nothing called owner. So I think she made the point, and I really thought that point was very good. There's a management, and there's a board, and there's no third party there. Board governs, management manages. Make sure the board is capable, make sure the management is good, and I think if you do this, things work out well. This is how we do things, and it has worked well for us.
Yeah.
Thanks, Rajeev. So, unlike Rajeev, who is predominantly or almost 100% doing control deals in mid-market companies, Multiples does predominantly minority deals with very strong, capable entrepreneurs who have excellent business going. Most of the companies that we invested in are already profitable. They are operating in a very interesting niche and have a potential to become very, very valuable. So our starting engagement with our companies is first very effectively communicating to them how to be fiduciarily responsible. Fiduciary responsibility comes to us as fund managers very naturally. There is nothing we own. We just are responsible. We are responsible to our investors who have put us in business. We are responsible to the companies to whom we have given money, and we are taking very significant stake. So my very dear friend and ex-colleague Suri in the audience will agree. There is a saying in Tamil called "Aindil valayadadu, aimbadil valayadu." What did not take shape or what did not happen at the age of 5 is not going to happen at the age of 50. Like how we raise our children with very, very strong family values, we raise our companies with very strong corporate values. We don't go with the assumption that we know more than them, or even worse, that they don't want to be a good governed company. Everybody wants to be a good governed company. In fact, many entrepreneurially run companies do not know what is good governance, why it is important, and how do I embrace it. So there is tremendous amount of effort we need to put in to engage with these companies and show them what is good governance, hold their hand, invest our time and energy. So there is a significant investment multiples is done. I have another colleague here, my chief compliance officer. The consistent response she gets after we make an investment, there is a board meeting called of this board. She'll call up the company and say, what's the agenda? They'll say, what? What is agenda? And she will have to say, no, you've called a board meeting. Can you please send the agenda? And that is where the journey begins for my compliance team in terms of saying, if you're calling a board meeting, you need to have an agenda. You need to send this agenda in advance. You need to, as Rajeev very correctly pointed out, engage the directors. What's the composition of your board? How much are you really sharing with the board? How much is the board looking into the management beyond the promoter, beyond the CEO or the CFO? Is there depth of management in the company? And then I can go on and on in terms of your risk management practices, your IT security, how safe is your company? What are your value system? How do you behave with your suppliers? How do you deal with your employees, right? Is there fairness in your business dealing? And then we can go to a higher level of sophistication on how much is the gender diversity in your company, right? What steps are you taking to make it safe and attractive for women to come and work in your company? So you keep elevating the game of governance with your portfolio companies. But to simply say that I have thrown a book at you and you follow this is not going to bring the results. It requires humongous investment of both human resources, which is cost to us, and effort on our part to really take these companies. And I will say that because we are very careful about who we back, we have had 100% success in terms of, putting very good governance practices in all our portfolio companies. And we look at, and I'm not saying this because I'm on a dais and I have to make, distinctive statements. We truly, truly believe that the best governance practices in our portfolio companies is a differentiator. It will get us better valuations as well when we go to exit these companies. And it is not a check in the box. And I'll also say one thing, it's a bit of an old story. So beyond my 23 years of experience in ICICI and all the great degrees I accumulated along the way, my best teaching or my best experience on governance came from a miserable failure that I had. I was sitting on this company called Subiksha, which was a blowout case. And it's a bit of the mercy of God and my parents and a miracle that I'm sitting here. because I could be in hell at this point of time. That taught me much more about governance than any speeches or courses that I could have attended. And what was the big mistake there? The big mistake there was the front end was just running in a trailblazing speed, commensurate with the aspirations of the entrepreneur, and the back end was left for another day to be built. And that day was never saw the light of the day, right? And along the way, we as directors and investors were sticking our neck out and saying that, hey, there is a great company being built. Here is an outstanding entrepreneur. Please understand his mission. He is able to give provisions and other daily use staples to Aam Aadmi at an affordable price. He has fantastic service model. And above all, let's be kind to him, because who is his competition? Ambanis are entering the business. There are really big players who are entering the business. How much can this one poor man do? Will he go and open shops so that others don't copy his model? Or will he go and build the backend? Right? And then you become so confused between being sympathetic, looking after your money, and don't want to be judgmental. You can't prove that something is going wrong. So the problem is that you only get a gut that something is wrong. And you cannot take action on a gut because the repercussions on your capital, on the employees, on the entrepreneur, in the marketplace, the lenders, is humongous. And what if the gut turned out to be wrong? You can never be acquitted of that mistake. So the lesson that I learned there was that the back end has to be ahead of the front end. It's okay if you grow at a lower rate. It's okay if you don't grow at all, if you have not built your back end. The back end could be team, back end could be good processes, it could be good IT systems, it could be good risk management systems. And then you grow the front end, and no sympathy can be given. Whether you are an entrepreneur with no big financial resources and big name, or fighting against big competition, I don't want to know the truth, because there is no scope for you to run the company on even slightly weak governance, let alone poor governance. And that university, I call it the Subiksha University certificate that I survived through, which helped me found multiples on the foundation that multiples will never compromise on. Governance comes first before everything else.
In fact, I was about to ask you about that blowout versus failure. I think you yourself mentioned about Subiksha as example, which is complete blowout. Clearly it comes out, again, management visionary, deep thinking, understands ground level realities, but whether those are sufficient actually to assess the company's basis you build the business, or you want to build the back end, strong back end, including supply chain management, inventory management, risk management process, etc. I think that's a very interesting point that you
The
made.
other thing
Just
that I've
one,
seen about Indian entrepreneurs is that they truly believe that I am telling you, what more do you want? Even now I see very large companies, Damodaran sir, you'll be surprised, companies making PAT of more than 500 crores and all of that. When we say, let's do a diligence, financial due diligence, they will say, why do you need it? I am telling you. Why is that not enough, right? So this whole fiduciary nature that you telling me is not good governance, I do believe you're running, but I need a third party who has the professional capability to endorse you as the one upholding good governance. Taking them on that journey is the most important one.
Yeah. Rajeev, you had some points to make?
No, I mean,
Okay. I think you mentioned about two things. I think even as an industry players, we have seen few challenges very recently. I think there was a company is going for increasing the borrowing in the company. It's a debt-free company and doesn't need cash at all to running the business. They have enough cash in the book, but still the company is going for rising debt. And despite the borrowing and passing a resolution for $1 billion borrowing, the debt equity doesn't change at all. The debt equity doesn't go alarming. There was a debate and discussions we all had, and And the analyst was saying that we have to vote against this company because they are suddenly coming to the market, passing a resolution for borrowing debt. So he wants to borrow money and rather take enabling resolutions. Therefore, on basis they can borrow. Then we debated, discussed, and finally we said the borrowing is meant for what? It's actually increasing the ROC of the company, ROE of the company for the future. That means it's making investment for the future. Therefore, in what capacity actually as an institution investor, though we have the right to tell the company what they are doing is right or wrong, at the same time, the borrowing is being done actually for building the future sustainable. I think both of you spoke about that. And of course, we reversed the decisions. We were supposed to vote against, then we said what we are voting is against that. And same way, we also seen companies, I think you mentioned about Subiksha's, and we as a firm also went through way back in 2000. Of course, most of you not even remember. There is an Y2K kind of solution. And none of us knew actually Y2K solution is a one-time solution on a particular day, night, that's it. Nothing beyond that. And all of us as industry players, we have exposures and then went and told the management, you must do this, this way you have to communicate, this way you have to inform the analysts and so on and so forth. They exactly probably they would have listened to what you said and what you guided them, but ultimately became utter failure. And then the company is not even in existence today. I think your experience, especially on these two things, capital allocation kind of thing, the independent director mentioned about, there are companies who are willing to bring the independent directors completely from the outside the field, outside the domain knowledge. Is the domain knowledge of particular industry is important, or the outside domain knowledge being there, but they are capable enough to bring in some differences to the way the board will operate, the way the questions will be raised, and so on and so forth. And if you can just throw some light on that, it will also be useful to see how companies can be made different by having people with a completely different background.
Sure. So, you know, if you see private equity, in 2000s, 2000, 2010, those 10 years, and those 10 years matter because this was the year, there's a decade in which India began to grow. Because if you see 2003 is the time when I think by and large adjustment had been completed from after the liberalized economic environment. And if you saw the financial ratios, I remember some of you who are interested, September 2003 quarter, if you see the results of that quarter and compare that with 1 year back, is sharp, jump away and totally different performance. So I think from that 2003 to 2010 or thereabout, with of course GFC in the middle, one thing that was very clear was that both a lot of focus on India, China, and everybody felt that in these two countries we should go in there, invest, and there would be an opportunity to own businesses here. India had a long history of capitalism and all that. China was talking all the right things. And I remember private equity those days saying that operating partners, very, very important. For 7, 8, 9 years, operating partners, industry knowledge to your question, hire somebody with financial institutions group, consumer, industrial, and those kind of 4, 5 different types of verticals. Have those people in the private equity business, and they will come and guide the companies. Utter failure. Utter failure. Because financial institutions, such a wide, industry. You could be insurance, lending, banking. You could be in mutual funds, private equity. There's a whole host of things that get categorized as financial institutions. And these guys would come from one background and try to lord over and try to teach people with regard to many businesses they had no familiarity with. By 2010, 11, 12, the thinking was very clear. Industry knowledge does not matter. Get wise business people who had experience and make sure that you brief them with regard to your industry as you understand it, fundamentals, changes, regulations, technology, who's growing, niches, etc., etc. Brief them and then leave it, with that briefing, leave it to their judgment to guide the companies. And that model from 2011-12 onwards has worked very well. Operating partners, the whole structure went away. The nomenclature may remain. People still, because I think invention of nomenclature has not happened. But those that, these operating partners that oversee the companies went away. And I think all of us started engaging people with basically senior management expertise and experience and briefing them. And they did a far better job. And by the way, they were also less offensive to management because they had came with a certain humility. They didn't come in as experts for that particular industry, micromanaging it. They came with a business background to say, listen, directionally this is right, this is not right, etc. And Rajeev is here, sir. A lot of people from State Bank of India brought a lot of capability and perspective to set the direction right. And our experience has been in Bala. You can see this across the board. Private equity let go of this so-called industry experts. They just did not work. This is the reality.
Yeah. So while Rajeev gave the perspective on this operating partner and influence or interference in the investments, my experience has been that, especially in public companies, it's very important to have a board which brings diversified domain expertise. And again, just to share my own little experience in Tata Communications, when I joined the board, I know nothing about technology, I know nothing about telecom, and it's a company that has been built with so many acquisitions from around the world. And I got invited by Tata's, which was, of course, a great honor for me. So I accepted, and then I said, what am I going to do here except look like a fool? I really can't add any value here. And to my luck, in the very first board meeting that I attended, where my children would say it's very difficult to get their mother to shut up. So I coached myself and I said, I'm not going to reveal my ignorance. I'm not going to speak in this board meeting. I'm simply going to absorb. Kept reminding myself. And then what really happened was there were only 3 agendas in the board meeting, and all 3 were investment proposals. So one was investment in a fund, another was investment to buy a company, and so on. And here I am kicking myself because I really want to say a lot of things, because I come from the investment domain, but I have said to myself, I'm not going to open my mouth. So the meeting ended, they agreed to all the 3 investments, and then I told my chairman, I came with a determination and not open my mouth, but I disagree with all the decisions. He said, I would have taken huge umbrage if you had not spoken up, in this meeting. And then life moved on and they actually reversed the decisions. They went into depth about everything that I had to say about why you want to. At least in that board meeting, they didn't record that they are making those investments. And along the way, we benefited a lot by having someone who is only focused on technology, another person who has huge IT services background. The company is making a big transition from just being a network provider to a solution provider. So we brought in board members who have run IT services companies, somebody with a HR background. I feel that diversity of experience at the board, where you are able to bring a holistic perspective of, is the business being, kind of well-oiled on all domains, is very, very useful. But we should remember that finally it is being run by the management. I'm not for a moment a votary of backseat driving. I hate one cap fit all model. And what is even more dangerous is when board of directors or other influential people start to think about, will I do this way? It is not about whether you will do it this way. It is very important to recognize that somebody else is going to do it. And is he or she well equipped, well prepared, and well supported to do it that way? It is very important to bring that mindset rather than develop a view based on, if I were him, I would not do this, and therefore I should not go with it. I think that would be my take on domain expertise and diversification of expertise on the board, and how you engage in being useful to the management in taking the right decisions.
I think more than diversity, it's also equally important to have directors with a different, varied background. Ignorance sometimes is considered as a bliss. So that's a good point. Just one last point before I open up the floor for questions. A new gen versus old gen. I think experience versus non-experience. I came across myself a company, again we had a debate. The father wants to bring the son into the business, and is coming up for voting. The first reaction is this 22-year-old boy, and why should we approve it? He doesn't have any experience running the company, and he is coming on the board. And I just remember Renuka mentioned about Aindil Velayadu, Aimbidil Velayadu, which essentially means that the seed that you put in at the age of 5, how it can grow and will continue to grow. If you don't put a seed, of course, it will not grow. So I presume a 22-year-old boy working with my father continuously, seeing him actually running the business, doing the business, I would probably assume the guy would be more equipped than somebody who is coming from outside. So it is a new gen, absolutely no doubt, but he's going to be part of an established company. Probably he will become the future leader. So what's your sense of this kind of, one is diversity, what spoke about earlier, he spoke about ignorance. I just want to, because the youngsters are becoming a very powerful leader as we speak.
Look, our experience has been, these are the biggest points of discontinuity in a company, the generational change. And there's more than half probability it will not work out. And this is the point where there's the biggest source of rancor between the independents and the so-called directors representing promoters. This is the biggest source of dispute and all that. History is against sticking to the generational thing. And I think this is one reason why, first of all, there's deal flow for private equity, because generational change is a discontinuity that many times now the kids themselves say we don't want to do the business.
Yeah.
But experience tells us world over that this discontinuity does not works to the detriment of the enterprise. So we have, I mean, it's not my experience necessarily, because 20 years is not enough to prove it, but last 300 years history tells us this detrimental discontinuity that has to be guarded against. So I think one has to be very careful.
Okay.
Yeah. As institutional investors, you have to really apply your mind and think about safeguards and all that. It doesn't work.
Okay. Thanks, Rajeev. Before you wind up, any questions from the audience? Yeah.
One is, as institutional investors, what are the role of proxy advisors in influencing the voting decisions? And I find in some cases, the proxy advisors hold a very high kind of a role, and especially foreign institutional investors depend on their suggestions and not necessarily think independently in terms of what is the meaning of the resolution, what are the kind of a role, and what is your opinion? Second question is, in the case of few companies, when they appoint the independent directors, there is a discriminated remuneration for the people who are from India and people who are appointed from abroad. Foreign people could be expats or could be even Indians employed abroad. Because they are from US or UK, they have a higher kind of expectation of remuneration. They negotiate or whatever happens. The resolutions very specifically say that the Indian director is just sitting fees, this is the commission or whatever is the percentage. But then the people who are coming from abroad have a higher remuneration, though it's within the statutory limits of 10% of the overall, all that is fine. That is ticking the box. But what is your opinion as institutional investors on voting on such resolutions? Thank you.
On the second part, anyone wants to answer? Or
Proxy advisor for you.
We don't do such things.
on the proxy advisors, definitely, of course, there are 3 proxy advisors. And one good thing on proxy advisor is they completely thread and analyze and give you pros and cons of every decision that's being proposed as the resolutions, whether it is appointment of independent directors and or with respect to the capital allocations or any other decision the company passes. They do, of course, their own analysis. And as the money managers, institutional investors, so because there are 3 opinions that has come, we pay attention. I mean, of course, we finally take a call what is the best interest of the shareholders and other stakeholders, and how the decision that is being taken by the company is going to hold a future value. So ultimately, our decision has to be driven by that, not necessarily only by the proxy voting agencies, what they recommend. So not necessarily we ignore the recommendations, but definitely the analysis that is being provided independent of us with unbiased manner. Maybe some bias could also be there, we do not know, but that's something we pay attention. It definitely helps in bringing a right level of debate and discussions and finally we take informed decisions. As far as the remuneration concern, I don't think it's as we talked about gender bias, diversity, etc. Definitely, India as a country, the border restrictions completely is going away. I think it doesn't matter whether it is from India or from abroad. Naturally, of course, the parity value is definitely different when you recruit people from outside. I think the way we look at it is, as long as the appointment is going to add accretion to the value of the shareholders, then the decision has to be approved. And that's the way we take decisions, we assess it, we evaluate it only on the basis. For example, the Jaguar turnaround which Tata Motors have done. Definitely somebody who is sitting in India, whether he could have created value for the company, or somebody who actually is international experience, of country level experience, understanding various countries, products and consumer behavior and so on and so forth, has a wider experience, therefore he can add value. That's the kind of something we have to debate and discuss, and basically take a call. I don't think we should be able to, we can actually, on the basis of remuneration, we can knock off anything, as long as the person actually is this high level of confidence on us that is going to create a shareholder's value. Yeah.
Thanks for the comments, ma'am. Rajeev, very interesting. Rajeev, you made a very interesting comment about the China situation. And I work for a pharmaceutical company, and this is whole rhetoric about China plus one and moving a lot of manufacturing to Indian companies as well. So what you said is that the return per dollar or rupee of investment in India has been more than what China has generated. I think completely agree, but if you could spend a minute talking a little bit more about what's the governance like in China for Chinese companies, how are their boards, what are the repercussions of the return for Chinese companies being less than India, what's the long-term implications, and something that Indian companies should be mindful of as the future develops, if you could comment on that. Thanks.
See, China had a lot of state-sponsored capital, and there was a lot of national ambition that Chinese various governments brought to their regions and their industries. You know, many years back, if you look at 60s and 70s, it used to be said, every country in the world wants to have one steel mill, one airline, one car company. And these three industries, therefore, became the worst industries to operate in over time, because airlines had some protections available with various complicated arrangements. Now, China has something very similar. The capital that Chinese brought, in most cases, was state-sponsored capital that really did not care much for return. So China got growth. They had massive investments. They created a lot of GDP. But the one set of stakeholders who did not really benefit from that was the provider of capital and the lenders, and therefore Chinese banks. Now that kind of a model was almost unthinkable for India, and therefore I think what we stuck to was a more conventional, Anglo-Saxon type of model. Stakeholders, capital, forget stakeholders anyway, capital providers must get returns, all capital providers. That's the only sustainable model. That's what we have done. Now, this has worked well. It means that massive investment will not happen. Investment will be measured. There will be logical tests applied to people making investments. We've had the problem of thermal energy. You know what happened in India, the kind of overinvestment and the results of that. China is living with that, but the banks they know how to deal with these kind of bad loans. They have their own way of dealing with the things. You can see Chinese banking multiples, the picture is very clear. Now with regard to this China plus one, based on that's going to come to us. See, if you talk to any company in chemical space, auto parts, engineering, they are inundated with inquiries. But these inquiries are going to come at Chinese prices. Nobody is going to pay you a premium. The question for us is therefore as follows. Can we make a return on capital supplying at Chinese prices? The answer is it's doubtful. And therefore China plus one is not as big an opportunity for countries with responsible capital as it is for countries with socialistic pattern of capital. This is the reality. And you should talk to the chemical companies. They already kind of winding down. Bala would possibly agree. Yeah. You can talk to the auto parts companies. supplying at Chinese prices, which are highly deflationary, is not easy for India. So that model will not translate over here, given our productivity levels and whole host of other things. And yeah, all that. The cost of leverage at the real cost is not going to work here. So don't get excited with this China plus one. By and large, of course, exceptions exist.
So what will be the implications, Rajeev? So what will happen to the Chinese economy since you have two stakeholders that are not happy with the returns that they're getting? What could be the long-term implications of that?
Is China a bit of conundrum? Because if you say for a minute that Chinese capital has been state-sponsored, then China should be welcoming private capital. They have injured private capital a great deal. So I don't have the answer to that, but the contradiction is very apparent. It's very difficult to understand the Chinese conduct. But in the last 2 months, if you've been seeing the press, they're trying to again talk to international capital providers, strategic capital providers, and talk and welcome them and back and all that. Because if the state capital is going to be forever there, it's another story. If you want to bring private capital, then whatever they did last 2-3 years is very hard to understand. So I don't know, but China will evolve, and China can live with a certain disaffection of people that we cannot live with. So I think there'll be very two different trajectories. To my mind, ours is more sustainable, but you know, market decides on a daily basis. Bala decides. So
I think you used the word, very interestingly, you used one word actually, which I just carefully saw it. If the private capital is injured, then it will have its huge repercussions. Therefore, we also cannot afford to injure a capital provider, create an injury for a capital provider. As I mentioned, China's private capital has been injured, so therefore they are suffering. So I think that's equally important in every country. And second is responsible investing. At the end of the day, it all sums up to the responsible investing, whichever way you call it. It all sums up to the responsible investing. And thank you, Renuka, and thank you, Rajeev. And thanks, Mr. Damodaran, sir, for having...
Bala,
Yeah.
I just quote Deng Xiaoping. He said, we can neither do without capital nor without capitalists. So, you know, what they're doing recently, capital is there, capital is not there, not going to work.
Yeah.
Thank you.
Thank you. Thank you, sir.
Thank you so much. Continue to be with us on stage. I request Mr. Damodaran to kindly join us once again. Ladies and gentlemen, you're going to see the caricatures for each one of our panelists being brought up onto stage. And we request Mr. Damodaran to present it to each one of our panelists. This caricature has been made right here during this session, and each panelist receives the caricature along with a certificate for 10 trees to be planted in their name in the Sundarbans. Thank you so much. Ladies and gentlemen, put your hands together for our moderator, Mr. A. Balasubramanian, Ms. Renuka Ramnath, Mr. Rajeev Gupta. Thank you so much. Capturing this special moment with a photograph, it always makes for a wonderful memory. Thank you for these truly useful insights. Time well invested, I'm sure all of you agree. Thank you very much. Appreciate your presence here with us on stage.